Hi. All right. I was talking to a good friend of mine the other day, and he's a very successful investor. He said to me, I'm very intrigued by this value of growth slides and presentations you've been putting up on YouTube and LinkedIn. He said, but I live in the world of PEs, price to earning ratios, and I'm having a little trouble how to use your valuation technique, your methodology, the model you've been using in my world of PEs. So I thought, oh, I could put a video up that explains how to use the value of growth in a PE world. This is that video. So let's see how we can do it. All right. So here's the first question you really want to think about. How do stocks go up over time? I think that this is one of my favorite questions. And it's very subtle. In fact, it took me a long time to figure out at least an explanation that I find operational or that I find useful. And so I'm going to walk you through the way I think about it. All right, so there's 4 conditions of which stocks will go up. Grow NOPAT or earnings. I use NOPAT as my primary metric for earnings. It's a cleaned up earnings. In a couple of lectures, I'll go into more details about NOPAT, but it's net operating profits after taxes. It's what Buffett calls owner's earnings. It's a cleaned up earnings. All right, so case 1, you grow NOPAT with a constant PE ratio. So price equals the PE ratio times earnings. If earnings go up over time, PE ratio holds, then the stock will go up over time. All right, case number 2, grow NOPAT and actually increase the PE ratio. And since price is PE times NOPAT, if the NOPAT grows and the PE ratio expands, then of course we have a higher stock price. Third case, you keep NOPAT constant and your PE ratio increases. Once again, price equals earnings times NOPAT. So if the NOPAT stays constant, but the PE ratio increases, stock price will go up. Fourth case, increase the PE ratio significantly to offset a decline in NOPAT. So NOPAT goes down over time, but the PE ratio goes up. All right, so I put this together in a little graphic to show you. So on the left, we have NOPAT. It grows, it stays constant, it declines. Those are your 3 rows. And then PE, it expands, stays constant, or contracts. So the green boxes, the stock goes up. And in the red boxes, the stock goes down. Yellow is kind of neutral. You don't know for sure because earnings go up, but the PE contracts. The stock, I don't know, could go up, could go down, could be flat. Same as NOPAT stays constant, PE stays constant, stock probably doesn't do anything, it goes sideways. All right, so then you ask yourself the next question, which is really 3, I guess 4, following the first 3 comments, is why do PE ratios stay constant over time? In our first case, we said grow NOPAT earnings with a constant PE ratio. So under what conditions would the PE ratio stay constant over time? And it's pretty simple. It's expectation, investor expectations, for NOPAT growth and incremental return on invested capital to hold over time. So for your PE to stay constant over time, expectations for future NOPAT growth and expectations for incremental return on capital need to hold over time. That's really essentially what a constant PE is. Why do PE ratios increase over time? Well, expectations for NOPAT growth increases while the incremental return on capital holds, or expectations for NOPAT growth holds, stays constant, while the incremental return increases. And then the third case is you could have both. Expectations for NOPAT growth increases and expectations for incremental return on capital increases. Stock price will go up. Or in this case, why do PEs either stay constant or expand? All right, now if your incremental ROIC goes up over time, then either your NOPAT margins are expanding or your invested capital is declining. That's how you get a higher incremental return on capital. So if expectations for a higher incremental return on invested capital were to go up, investors think either the NOPAT margins are going to expand or the amount of capital invested in the business will incrementally go down over time. If your NOPAT margins increase over time, then your NOPAT and your earnings power value grow faster than revenue. So the company's becoming more valuable on an earnings basis. If invested capital goes down, then the business will generate additional excess capital that could either be redeployed in the business, presumably at an attractive incremental return on capital, or returned to shareholders. So that's sort of the setup, if you will. All right, here's the valuation challenge, and you'll recognize this chart. It comes from my first lecture, the Value X lecture that I gave when I was at Berkshire in Omaha a couple of weeks ago. All right, so this is a standard, it's going to be effectively a DCF, but each of these years represent a year in the future, and then the black bar represents the yearly NOPAT. All right, now if we split the bars, the NOPAT, future NOPAT, into two pieces, the no growth piece and the growth piece, you end up with a chart that looks like this. The blue is that constant NOPAT, no growth in future years, and green then is your growth in NOPAT. That's a way to think about it. All right, from a valuation perspective, valuing the blue part is fairly trivial. I'll come back to that in a future lecture, but it's essentially a perpetuity that lasts forever. The green part is the hard one to calculate. And what's really important to recognize is that green over time is really investor expectations for growth, not the actual growth itself. All right, so now if the enterprise value is going to increase over time, that's why the stock goes up, we then have, I'll go through four cases. The first case is earnings power went up and the market implied value of growth went up. Both increase, and of course, if both are increasing, the stock price will go up. What I've talked about before, and I will talk about more in the future, is the idea that earnings power value is derived by the company's financial performance, while market implied value of growth is investor expectations for future growth of the company. So blue on the left is driven by the fundamentals of the company. Green on the right is really investor expectations. So in our first case, earnings power value goes up and investor expectations for growth goes up. And you could see the stock price goes up. That makes sense. All right, case number two. Earnings power value goes up over time, but investors' expectations about future growth don't. They stay constant over time. So EPV goes up, but market implied value of growth goes sideways or remains constant. We still have enterprise value that increases. So first case, both earnings power value increased over time and investor expectations for future growth increased. Second one, we have, going back, the earnings power value goes up, but investor expectations about future growth stay steady. That's okay. Enterprise value still increases. Third case is earnings power value goes flat. The company doesn't do much, but investor expectations about the future goes up. So this is kind of the opposite of the second case. Second case is earning power value went up, but the market implied value of growth, investor expectations were constant over time. This is the case where earnings power value was flat over time, but market implied value of growth increased over time. By the way, this is Apple. In my last lecture, I talked about Apple, and this is exactly what happened to Apple. All right, even under these conditions, the enterprise value increased, stock goes up. All right, our fourth case is the earnings power value actually declines over time, but investor expectations about future growth increases more than the decline in earnings power value. Now, this is an unusual case because you would think if the earnings power value is coming down over time, the market implied value of growth would also come down. But there are cases where maybe the company's investing in a new product, a new business, a new plant, or expanding manufacturing, and it's bringing down your earnings power, your NOPAT. So it's bringing down your earnings power value. But investors are very excited about the potential of the new product, new manufacturing, or whatever the case. So this is possible, unusual, but possible. And in these cases, the stock goes up. Now, the stock doesn't go up as much as it would if earnings power value was constant over time. All right, so now here's what's interesting is we can now map the charts with the blue and green back to a similar table that we had for PEs. So this becomes important. So on the left, we have earnings power value instead of NOPAT. And so it grows, stays constant, or declines. And then your market implied value of growth either increases, stays constant, or decreases. Well, the maps perfectly back to our PE table. And the green is where the stock goes up, or enterprise value goes up. The red, the stock price goes down. Yellow is that neutral. So if that's true, then PE is essentially NOPAT capitalized, earnings power value, plus market implied value of growth. So now we've come all the way back full circle where we take the original market implied value of growth equation, the market implied value of growth model, translate it to PEs. Now I have PE relatively equivalent for really two reasons. One, NOPAT is not earnings. It's a cleaned up earnings, and PEs are often talked about versus earnings, price to earnings, accounting earnings. So there has to be a little bit of an adjustment there. Maps perfectly. I just think PEs can be very polluted. And a lot of investors actually look at a modified or adjusted PE, cleaning up the earnings to make it closer to NOPAT. And then plus the market implied value of growth. Now, technically, it's the market implied value of growth as a percentage of enterprise value, something I'll flesh out in a few videos. But we now have an exact translation between PE and market implied value of growth. So the higher the market implied value of growth, the higher the PE. Invert it, the higher the PE, the higher the market implied value of growth. What is market implied value of growth? Investor expectations about future growth. So a high PE would have a high investor expectations about future growth. So that maps perfectly. So we can map this really nicely. I think that once you get here, it all sort of makes sense. All right, now here's something that's kind of fun is market implied NOPAT growth rates with PEs. You can tease out what the market implied growth rate it is by using these equations. So the equation on the left might seem a little intimidating. It's not. It's essentially the current PE minus 1 over the cost of capital. Think of that as a cap rate. The difference between the PE and that 1 over the cost of capital is essentially your excess PE. That is your market implied value of growth in PE terms, and then divided by PE. So it's the percentage of PE that is greater than your cap rate. That's the way you think about it. You multiply that by the cost of capital, and you get something called the market implied expected growth rate. I'm going to go into way more detail in this in a few weeks, but I just want to give it to you. And now here's something that's really fun. Use the same equation on the left, the percentage of the PE that represents growth, and you multiply that by your expected return, and that's your estimated growth rate. So the equation at the top is the market implied growth rate. And for you, since you want to have a higher return than the market return or higher return than the cost of capital as an investor, you obviously need a higher growth rate. Okay, great. All right, now we can actually put this into a very simple table. For those of you interested, you can pause the video and do a screen capture. But cost of capital on the left, I ran that from 8 to 12, and then PEs from 15 to 25. And then what I've calculated is the percentage of the value that is captured in growth, or in this case, the percentage of the PE that is represented by growth. So if I have an 8% cost of capital and a 20 PE, 37.5% of that PE is growth. On the other hand, if I have a 12% cost of capital and a 25 PE, 2/3, that's the one in the lower right corner, 2/3 of that PE represents growth. All right. Now, with the formula I used before, we can actually imply the perpetual growth rate. Same two examples. Cost of capital is 8%, PE's 20 times. The implied perpetual growth rate is 3% a year forever. Or 12% cost of capital, 25 PE. The implied perpetual growth rate is 8%, lower right corner. All right. Now what you can do is you can actually invert it and look at the implied PE from growth. So you think about the first column, there's no growth. What would be the appropriate PE for that company? All a function of the cost of capital. If you have no growth, perpetuity, like a bond, 8% cost of capital, then that is a 12.5 PE. On the other hand, if you thought at an 8% cost of capital, you thought the company can grow for a long time, then guess what? Your PE at 24 times, 11.5% of that PE, or 11.5 of the 24, so almost 50%, is growth. So this is just a way to think about it. And what this allows you to do is start with the PE on the left, and then depending on your cost of capital, you can impute what the correct PE is given the growth. All right, and then implied percent of PE from growth is just the exact same formula, but just divided by. All right, so that's how I think about value of growth used in a PE world. It translates very straightforward, very easily. The way you want to think about it is start with a cap rate. Just take your cost, I would go back here, take your no growth value, perpetuity with your cost of capital, and then you can see how much of the PE is going to be what percent of the PE. This is the percent of the PE, but here's the amount of PE that you would get from growth. And then this is your perpetual growth rates. Again, you can pause the video, take a screenshot, and look at this. All right, that's it. I thank everyone for their time.